Alphabet's market cap stood at $4.81 trillion on Wednesday. Nvidia sat at $5.05 trillion. The gap between them, $240 billion, is now smaller than what four companies plan to spend on data centers in a single year. That $725 billion figure is the combined 2026 capital expenditure commitment from Amazon, Microsoft, Alphabet, and Meta. It represents a 77% increase over 2025, and nearly all of it is going into compute, not payroll or stores. Meta's AI infrastructure budget alone runs 4 to 5 times what the company spends on total human compensation. When Zuckerberg told 8,000 employees their jobs were casualties of the AI budget in early May, he was not speaking in metaphor. He was describing a line item. The market has not treated all four names the same way. Alphabet is up 27% year-to-date. Amazon is up 17%. Microsoft is down 13%. And Meta is down 6%. The divergence tracks where backlog is visible. Alphabet's Google Cloud carries $462 billion in contracted future revenue, growing 63% in the first quarter to $20 billion for the quarter alone. Amazon's AWS backlog stands at $364 billion, plus a separate $100 billion plus Anthropic deal not included in that figure. Microsoft and Meta are spending at the same scale, but the signed customer commitments aren't converting at the same rate, and investors are pricing the gap. That capital reallocation is reshaping the semiconductor equipment cycle in ways that don't show up in the hyperscaler headlines. Lam Research surged another 8% this week after earnings, extending a nearly 300% run over the past 12 months. At 33 times forward earnings, the stock trades well above historical norms. Bank of America is targeting 330. The argument is not that Lam is cheap, it is that the multiple reflects how far the foundry expansion cycle still has to run. Every new data center that Amazon or Alphabet commits to requires etching tools, deposition chambers, and cleaning systems before a single GPU can be installed. Lam collects that toll further upstream than the chip stocks. The risk is that hyperscaler Capex commentary turns cautious. The signal to watch is whether Nvidia's fiscal Q1 guide of $78 billion prints cleanly in its upcoming report. But the same earnings season that validated Alphabet's cloud thesis also surfaced a fracture running beneath the AI boom. Whirlpool slashed four-year guidance to $3 to $3.50 in earnings per share and suspended its dividend, citing what it called a recession-level industry decline. Consumer sentiment, according to the University of Michigan, set at 53.3, firmly in recessionary territory, while the VIX held below 18 and stocks traded near records. The infrastructure economy and the consumer economy are not operating in the same year. That fracture has a single dominant cause, and it is not interest rates or tariffs. The Strait of Hormuz has been effectively closed since February. Gas prices averaged $4.56 a gallon on May 6th, up 62% since January 1. Ford's CFO told analysts this week that aluminum costs have torn a $1 billion hole in the company's commodity outlook for 2026. The London Metal Exchange aluminum contract is up 19% year-to-date and sitting at its highest level since 2022. The mechanism is geographic. Gulf aluminum smelters account for roughly 7% of global primary supply. Military strikes have taken about 3% of that supply offline outright. Aluminum Bahrain has idled 19% of its melting capacity. Qatar's Qatalum is running at 60%. This same waterway that bottled up a fifth of the world's daily petroleum liquids is also bottling up the metal that goes into every pickup truck body panel, every wing. Ford's exposure is specific. The company spends roughly $8 billion a year on steel and aluminum combined, with aluminum representing about 40% of that buy. The F-150's aluminum body, a deliberate bet on fuel efficiency made a decade ago, now exposes Ford to a commodity squeeze that rivals using steel-heavy designs are partially avoiding. Full-year adjusted operating income guidance sits between $8.5 billion and $10.5 billion. A sustained aluminum price 20% above current expectations could shave another $500 million off the top before any other surprise lands. The expected relief hasn't arrived. Iran announced this week it has created a government agency, the Persian Gulf Strait Authority, to vet and collect tolls from vessels seeking passage through the strait. Iran said it was still reviewing U.S. peace proposals forwarded through Pakistan, but has not yet reached a conclusion. Crude oil fell more than 7% on peace deal optimism earlier this week, and Brent futures sit near $99. Gas prices moved up on the same day crude fell. Patrick DeHaan of Gas Buddy told NBC News recently that retail prices probably won't come down meaningfully until late summer at the earliest. The Strait Authority is the critical variable. If it formalizes into an operating toll regime, even under a partial ceasefire, the oil disruption becomes a structural cost, not an acute shock. That distinction matters for every company between the Gulf and a U.S. retail shelf.
The Hormuz closure is now feeding directly into Federal Reserve policy expectations, and that transmission chain is the one investors have been slowest to price. Bond traders this week are pricing more than a 50% probability that the Fed raises interest rates before cutting them, according to swaps data reported by Bloomberg. That is not a consensus call, it is a hedge. The shift comes after the Fed's April 29th meeting produced an 8-4 vote to hold rates at 3.50 to 3.75%, with 4 dissents, the most divided FOMC in more than 3 decades. 3 regional presidents, Kashkari in Minneapolis, Hammack in Cleveland, and Logan in Dallas, each released independent statements saying the Fed should explicitly signal that the next move could be a hike, not a cut. The mechanism is sequential. The Iran war has held energy prices elevated for more than 2 months. Elevated energy prices feed into transport, food, and manufacturing costs. The May 8th jobs report, expected to show labor market conditions stabilizing, removes the last clear argument for near-term cuts. Kevin Warsh, Trump's Fed chair nominee, cleared the Senate Banking Committee on April 29th and is expected to be confirmed the week of May 11, before Powell's term expires on May 15th. Warsh has called for lower rates, but he inherits an inflation environment shaped by a war the Fed cannot control. The 10-year Treasury yield sat at 4.33% this week, the 88th percentile of its one-year range. The 30-year held near 4.93%. Lawrence Gillum at LPL Financial told Bloomberg the chances of a rate cut this year are falling the longer the Iran conflict continues. John Briggs at Natisix said traders don't want to repeat 2022, when being caught flat-footed on inflation cost them dearly. The stock-level consequence runs through 2 channels. Growth equities, particularly the AI infrastructure names trading at high multiples of forward earnings, face compression if the 10-year pushes above 5%. That level would be the second clean catalyst to test the AI Capex thesis after NVIDIA's upcoming earnings report. The second channel is credit-sensitive sectors, REITs, regional banks, and home builders, where the 30-year yield already sits near 5%, and mortgage rates remain elevated. The verification benchmark to watch is the 30-year Treasury. If it holds above 5% through next week while the Warsh confirmation proceeds, the rate hike trade has institutional backing. If it retreats below 4.75% alongside credible Hormuz de-escalation, the dovish scenario reopens. The 2 conditions, peace deal and rate path, are not independent. The Strait Authority announcement this week suggests the market has not yet priced the scenario where the strait stays partially closed under a formal Iranian toll regime, oil stays above $90, and Warsh arrives with a mandate to defend Fed independence against political pressure for cuts. That collision, if it lands, is what the 50% hike probability is hedging against. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.